Okay, let's actually start off. So we had a session, we have had 2 days of the session, and over the past 2 days, we have actually focused upon two, three areas. One of them is we have actually gone through the interest rate risk management, and the areas in the interest rate risk management that we have actually covered up till now include the interest rate futures, include the interest rate options, the forward rate agreements, and in addition to this, the areas that we have covered up is actually the collars, and we've also covered up the interest rate collar. And in addition to the interest rate collar, the area that we have actually covered up is um, we have covered them up, and we went through the multilateral netting in the yesterday's class also. So what I'm actually going to do now is that I'm now going to move forward, and I'm now going to have a discussion about the other areas. And the next area that we are actually going to discuss is actually the swaps. Now let's actually discuss about the swaps, that what exactly is the concept of a swap. So we are going to cover up the interest rate swap and the currency swap. That's what we are going to do. So let's actually talk about the swaps. So first of all, what I'm actually going to discuss is what exactly is a swap contract. A swap contract is a contract where one stream of cash flow is exchanged with another stream of cash flow. Swap is a contract where one stream of cash flow is exchanged with another stream of cash flow. So that's what a swap agreement is. What's a swap agreement? A swap agreement is an agreement where one stream of cash flow is exchanged with another stream of cash flow. Now, what exactly do you mean by exchanging one stream of cash flow with another stream of cash flow? Let's actually discuss about it. So if I'm going to talk about two types of swap. One of them is the interest rate swap, and the other one of them is the currency swap. Now, what is an interest rate swap and what is a currency swap? Let's actually discuss. Usually what happens is when we talk about the borrowings, so generally speaking, the borrowings that we actually do are of two types. One of them is the fixed rate borrowing, and the other one of them is a floating rate borrowing. The other one of them is a floating rate borrowing. So we have got two types of borrowing. One of them is a fixed rate borrowing, and the other one of them is a floating rate borrowing. Now, what exactly is a fixed rate borrowing and what exactly is a floating rate borrowing? So if I talk about a fixed rate borrowing and the floating rate borrowing, let's discuss. Fixed rate borrowing is when you borrow, let's say at 10%. Floating rate borrowing is when you borrow at, let's say, LIBOR plus 2% or whatsoever. So there is actually a difference between a fixed rate borrowing and a floating rate borrowing. Fixed rate borrowing is the interest rate is fixed, and the floating rate borrowing is the interest rate is not fixed. It keeps on fluctuating. Generally what happens is that in case if you have borrowed from a bank at fixed rate, let's say you borrowed at 10%, you are expecting that the market interest rates would actually go down to 7%. So in order to protect yourself, what you have actually done is that you have requested the bank to actually convert this fixed rate borrowing into the floating rate loan. Now, so when you will actually go to the bank for the conversion of this fixed rate borrowing into the floating rate borrowing, let's actually discuss about it. What is exactly going to happen? The bank is actually going to charge you. A substantial amount of money, because for the bank, if you actually change this is actually for the bank, what exactly is it going to be? This is actually going to be cancellation of existing loan. This is going to be a cancellation of existing loan. And in addition to the cancellation of the existing loan, for the bank, this is actually going to be an early settlement. So what the bank is going to do is that bank is going to charge a heavy penalty upon you, and the bank is going to charge heavily to you. So what exactly is going to happen? what exactly is going to happen is, if the bank is going to charge you heavily onto this, then you would actually prefer to continue with your fixed rate borrowing, because what happens is that you would be better off continuing with your fixed rate borrowing, because the change of the loan might not actually give you that much amount of benefit as compared to the cost that you would have to incur in order to change this loan. Similarly, assume that there is a company who is operating at a floating rate. Assume that there is a company who is actually operating in a floating rate terms. Now, if there's a company who's operating at floating rate, so what exactly is going to happen with that floating rate company? If that floating rate company wants to convert into fixed rate borrowing, then what exactly is going to happen? If the floating rate company is going to convert into fixed rate borrowing, then what is going to happen is that company is facing a risk that the interest rate would actually go up. If that company is facing a risk that the interest rate would go up, so what the company would actually want to do is that it would request its bank to convert this borrowing into the fixed rate borrowing. Now, if it is going to request its bank to convert this into fixed rate borrowing, the bank would do the same treatment with this company also, that the bank is actually going to tell them that you have to pay X amount of penalty, you have to pay X amount of charges, and then we would actually convert your borrowing. So basically what is going to happen is that what is exactly going to happen is that um, the company would actually prefer to continue with the floating rate rather than converting its loan into the fixed rate. So that is actually going to happen. Now, so we had two companies. One of them had a fixed rate borrowing and the other one of them had a floating rate borrowing. So for the fixed rate borrowing company, what have we actually done? For the fixed rate borrowing company, the fixed rate borrowing company wanted to convert it into the floating rate, but it could not. The floating rate borrowing company wanted to convert it into the fixed rate and it could not. Now what next? So basically what is going to happen is that the bank actually enters in between these two companies, and the bank actually makes these company contract with each other. Now what is going to be the contract between both of them company? The bank is going to say to company A that you've got a borrowing at fixed percent, which is 10%, and the company B, you have got a borrowing at LIBOR plus, let's say, 2%. So the bank would instruct bank would say to company A that you're not going to pay the interest of company A. Bank would tell company A that your cost. So now what is going to happen is the bank would actually make both of these companies deal with each other. Now how would the bank actually make both of these companies deal with each other? The deal is going to be like this, that bank would tell company A that you wanted to convert your borrowing into the floating rate borrowing. Why not you exchange your interest rate liability with company B? And the bank would instruct company B that you wanted to convert your borrowing into fixed rate borrowing. Why don't you exchange your interest liability with company A? So resultingly, what is actually going to happen is the swap agreement is going to be entered between this company A and company B. And the swap contract would operate in such a manner. That when we talk about the swap contract would operate in such a manner that company A's liability would be borne by company B and the company B's liability would be borne by company A. So resultingly, how does this all going to operate? This all is going to operate this way. which is, let's say if the LIBOR is, let's say LIBOR is 7%, then what would happen is the company A would actually pay to its bank 10%. Company B would pay to its bank uh, 7% plus 2%, which is 9%. And then there is actually going to be a settlement between both of these companies under the swap. And under the swap, what would happen is the company B would actually pay 1% to company A, and company A is being paid 1% by company B. The company B would stand at 10%, and the company A would stand at 9%. Resultingly, what is actually going to happen is, the company A's liability would be LIBOR plus 2%, and company B's liability is going to be 10%. Okay, so how the swap operates is you exchange each other's liability, and when you exchange each other's liability, so that's how actually the fixed rate loan is converted into floating rate loan without the cancellation of the loan with the bank, and the floating rate loan is converted into fixed rate loan without the cancellation with the bank. Okay, now there is somebody asking a question: why would company enter into such swap? So one thing is that the company A had a 10% fixed rate borrowing, and the company A was facing a risk that the interest rates would actually, the company A was facing a risk that the interest rates would go down and they would still end up paying the interest at 10%. Similarly, the company B was paying the interest at LIBOR plus 2%, and it was actually facing a risk that the interest rates would actually go up, and they would end up paying an extra cost. So they wanted to convert their loan into fixed. Company A wanted to convert their loan into floating, because both of the companies had opposite expectations. That's why they wanted to transform their loans. Okay, I'm going to explain that how is it going to operate. First of all, now how is the swap going to operate? Now let's just try to understand. How the swap actually works is, assume that this is called a company A and this is called company B. Fixed rate loan, floating rate loan. Okay, these are two companies, company A and company B. Now the situation is like this. Company A is being offered fixed rate borrowing at 10%, and company A is being offered the floating rate borrowing at LIBOR plus 1%. Similarly, company B is being offered fixed rate borrowing at 12%, and the floating rate borrowing at LIBOR. Now what happens next? What happens next is actually going to be the company A and company B have decided that they are actually going to borrow in collaboration. Company A and company B have decided that they are going to borrow in collaboration. Now, how exactly are they going to borrow? So what they have decided is that they are going to compare they're going to compare the rates that are being offered to them. So now when they actually compared the rates that are being offered to them, so there is a 2% differential in the fixed rate borrowing and there's a 1% differential in the floating rate borrowing. So when there is a 1% differential in the floating rate borrowing, now what exactly is going to happen? What is exactly going to happen is that the company fixed rate borrowing, you've got a differential of 2%, and in the floating rate borrowing, you've got a differential of 1%. So what you would do is that you would try to encash this 2% by ensuring that company A borrows at fixed rate. Now, if the company A borrows at fixed rate, so the company B needs to borrow at floating rate then. So the first thing is, what are you going to do? You're going to compare the rates that are being offered for the fixed and the floating rate borrowing to both the companies. Once you have compared the rates that are being offered to the fixed for the fixed and the floating rate borrowing to both the companies, then the next step that is actually going to take place is you are going to try to capture the maximum benefit that is available. The maximum benefit that is available in this scenario is actually 2%. So we tried to capture this benefit. When we tried to capture this benefit, we ensured that company A borrows at fixed rate. Now, if the company A has borrowed at fixed rate, the company B has to borrow at floating rate. Now, if the B borrows at floating rate, that's also a borrowing which is actually relatively cheaper than the borrowing that the fixed rate company did. Now, what next? Next situation is that if this is how it is going to be, so overall what would happen is there is going to be a saving of 3%. Now you would say, why is there going to be a saving of 3%? There is going to be a saving of 3% because had it been a normal case, the company A would have borrowed at LIBOR plus 1% and company B would have borrowed at 12%. So it would have been LIBOR plus 13%. It would have been LIBOR plus 30%. But now, since it is not the case, what has actually happened now is A has borrowed at 10% and B has borrowed at LIBOR. So resultingly, what is actually going to happen is there is going to be a net saving of 3%. So I'm repeating it again because of the swap agreement. What happened is one of the company could borrow at fixed at 10%. The other company could borrow in the floating at LIBOR. So basically what we did was we determined the differential between them to be 2% and 1% gives out to be 33%. And what we actually did was for the A, we said that it's LIBOR plus 1%. For B, it's 12%. Total is LIBOR plus 13%. Had there been no swap. But now since there is a swap, so it's actually going to be 10% and LIBOR. So resultingly, you will have a saving of 3%. Are you okay with this? Okay, now, how is this saving going to be treated? We need to discuss. Now, what can actually happen is how exactly are we going to deal with the savings? There could be multiple arrangements. The simple arrangement is we are actually assuming that this 3% saving is going to be shared equally. Now, if it is actually going to be shared equally, then what is going to happen is A and B. A is going to get 1.5% of the saving. B is going to get 1.5% of the saving. Now, if we say A is going to get 1.5%, B is going to get 1.5%. So what exactly do we mean by this? This would actually mean that the final result is going to be A would stand at LIBOR plus 1% minus 1.5%. Minus 1.5%, resultingly, they are going to be LIBOR minus 0.5%. They are going to be LIBOR minus 0.5%. Now similarly, number 2 is going to be Company B, had they not borrowed, it would have been 12% minus 1.5%, they would have been 10.5%. So basically what is actually going to happen is the end result, the net cost that both of them would have to bear would be, A would have to bear a cost of LIBOR minus 0.5 and B would have to bear a cost of 10.5%. Resultingly, this combined cost is going to be LIBOR plus 10%. Okay, so now what next? So this is how generally LIBOR operates, that what happens is that you agree to a combined saving and then you actually decide to actually split the saving in whatever proportion that could be feasible. Now let's move forward. What I would want you people to do is that to come on to question number, this is actually question number 3 of June 2017. It's actually March June 2017. You need to come on to question number 3. March June 2017, question number 3. So let's talk about this question, March June 2017. Question number 3. It's about BurryX company. It's BurryX company. You need to actually attempt this question. BurryX company. Okay, let's have a discussion about this question. You go through this question. We'll start discussing in 3-4 minutes. So let's just start discussing about this question. This question actually tells you that the company is an international transport operator based in the Eurozone, which has been invited to take over a rail operating franchise in Virtonia, where the local currency is the dollar. Previously, this franchise was run by a local operator in Virtonia, but its performance was unsatisfactory and the government in Virtonia withdrew the franchise. Now, it says the company will pay $5,000 million for the rail franchise immediately. The government has stated that Barriex should make an annual income from the franchise of $600 million in each of the next 3 years. And further, it says at the end of the 3 years, the government has offered to buy the franchise back for $7,500 million if no other operator can be found to take over the franchise. Now, it says that today the spot exchange rate between the euro and the Virtonia is Virtonia dollar is euro 0.143 is equivalent to 1 Virtonia dollar. The predicted inflation rates are as follows: Eurozone and the Virtonia. Now, it says Barriex Company's finance director has contacted its bankers with a view to arranging a currency swap, since he believes that this will be the best way to manage financial risk associated with the franchise. Now, the swap could be for the initial fee. The swap could be for the initial fee paid for the franchise, with the swap of principal immediately and in 3 years' time, both these swaps being at today's spot rate. In addition, it says that the company could, Barriex Bank would charge an annual fee of 0.5% in pound. For arranging the swap, Barriex would take 60% of any benefit of the swap before deducting bank fee, but would they have to pay 60% of the bank fee. Now it says relevant borrowing rates. It says the relevant borrowing rates. It says the relevant borrowing rates are as follows: the Barriex Company, Eurozone, counterparty, Virtonia, etc. etc. In order to provide Barriex Company's board with alternative hedging method to consider, the finance director has obtained the following information about OTC options in Virtonia from the company's bank. The exercise price is so and so. Assume a discount rate of so and so. It says discuss the advantages and drawbacks of using the currency swaps to manage the financial risk associated with the franchise in Virtonia. Now let's actually talk about the advantages and the disadvantages of the swap and what exactly is the company willing to do in this specific scenario. Basically, what happens is that when we actually talk about a currency swap, now how exactly is a currency swap different to the interest rate swap? Assume that there's a company based in UK and there's a company based in USA. The company which is based in UK wants to establish a subsidiary in USA, and the company which is based in USA wants to establish a subsidiary in UK. So what have we got? We've got a company based in UK who wants to establish a subsidiary in USA, and we've got a company which is based in USA who wants to establish a subsidiary in UK. Now, what they are expecting, the UK company are expecting that they would actually invest 100,000 pound sterling into this. And the present exchange rate, assume that present exchange rate is dollar upon pound as 1.5. And the USA company is actually expecting to invest around $150,000 in UK. Now, what actually happens is, if the USA company is going to transfer these funds would be converted by its UK-based subsidiary and they would equate to 100,000 pounds. If the UK-based subsidiary transfers the funds, they would be converted into US dollar 150,000. So instead of these transactions moving from UK to USA and from USA to UK, what actually happens is from USA to UK, UK to USA, what happens is these companies, they actually decide that the UK company, which is some other company, is going to make payment of 100,000 pounds to this subsidiary of the USA company, and the USA company will pay 150,000 pounds payment, $150,000 payment to it. So there is actually no need for any transfers. So what has actually happened is they directly transfer the money. Now, every year there's going to be some return which needs to be remitted back to UK, some return which needs to be remitted back to US. So what exactly is going to happen is they are not going to remit the return, but instead the returns would actually be transmitted this way. So resultingly, what would happen is the inter-country transfers would not take place. Resultingly, what would happen is the inter-country transfers would not take place. And if the inter-country transfers are not going to take place, then what exactly is going to happen? Then exactly is going to happen is that if there are no inter-country transfers, then it is actually going to be the case that where you will have to the currencies would actually be remitted to the respective parent entities, and each of the parent entity would have actually got the amount that it might have actually received from its own subsidiary. So that's how the currency swap actually operates. Do you get it? Okay, now what next? Okay, now what next? So basically what happens in the currency swap is there might actually be the case. I've given a very simple example that the currency from one country transfers to another country and it's exactly the same amount, but practically this does not happen. Practically what happens is the amounts are different. So when we enter into a swap, we agree to a notional amount. Now what is that notional amount? That's an assumed amount that we would ever swap on 100,000 pounds or 100,000 euros or whatsoever. And then whatever the amount over and above that is actually unhedged through, that is not hedged through swap, and that the entity could actually operate in its own manner. So that's how it actually operates. Now in this given scenario, they're actually asking discuss the advantages and drawbacks of using the currency swap to manage the financial risk associated with the franchise in Vertonia. Now, what exactly is the advantage and what exactly is the disadvantage of managing these through the swaps? So I'm actually going to talk about few advantages and I'm going to talk about few disadvantages also. So if we talk about few advantages and if we talk about few disadvantages, let's actually have a discussion. One of the advantages basically easy to enter. The second thing is that low cost. The disadvantage is basically it's a binding contract, cannot take advantage of favorable movements. Then there is actually a counterparty risk. So basically these are the generally advantages and drawbacks of entering into a swap. Now let's move forward. It says calculate the annual percentage saving. Calculate the annual percentage saving which Barriex company would make from using a currency swap compared with borrowing directly in Vertonia, demonstrating how the currency swap will work. Now let's actually try to attempt this scenario. So you do know that the entity can borrow at fixed rate, the entity can borrow at floating rate. So let's actually try to attempt its question. Okay, so how exactly is it going to work? What would happen is we need to actually establish this thing that okay, so that's what you have. You have got that in the Eurozone, we have got Barriex company which is being offered 4% rate, and the counterparty who's being offered 5.8% rate. The other one of them is actually in the country Vertonia. They've got zero point 0.6 and they've got zero point 0.4. So the first thing that we do is that we try to establish the differential. The first thing that we do is we try to establish the differential. Now, the differential that we try to establish is actually like this. We say that it is 1.8% and we say that this difference is actually 0.2%. Now, since this 1.8% is a higher differential, we would try to capture this by ensuring that Barriex company buys from Eurozone at 4%. And if Barriex company borrows from Eurozone at 4%, then here the counterparty would have to borrow in Vertonia for, let's say, 0.4%, W plus 0.4%. So resultingly, this is also going to be saving, this is also going to be saving. So in total, the total saving is going to be of 2%. Now, if the total saving is going to be of 2%, now what exactly is going to happen? Okay, now, so the total saving is actually 2%. Now, if the total saving is actually 2%, out of this saving, what would happen is 60% would go to Barriex company, and resultingly, the 40% would go to the Vertonian counterparty. So the 60% out of this 2% is going to be 1.2%. This is going to be 0.8%. This is going to be 1.2%. This is going to be 0.8%. Now, what next? The next situation that is actually going to happen is that this is actually going to be 1.2%, this is going to be 0.8%. And the question also says that there is actually going to be a cost, and how much that cost is going to be. That cost is going to be, the bank is going to charge 0.5% as the annual fee. So if we actually charge the bank fee, which is actually 0.5%, of the 0.5%, you will have the 60% to be borne by BuddyX company. So that means the 0.3% is going to be borne by them, resultingly it's going to be 0.9%. The 40% is going to be borne by them, which is going to be 0.2%. That means it would be 0.6%. So resultingly, if the examiner is asking you that what exactly is going, the question was actually calculate the annual percentage saving which BuddyX company could make from using a currency swap compared with borrowing directly. So the percentage saving that they are going to do is going to be 0.9%. The percentage saving that they are going to be doing is actually going to be the 0.9%. Now, uh, if you're going to demonstrate how the swap will work, so what would happen is, see here, BuddyX company, the counterparty. BuddyX company would pay to its bank 4%, and the counterparty would pay to its bank W plus 0.4%. But had there been no swap, BuddyX company would have actually been paying to its bank how much? W plus 0.6%. And they would have been paying 5.8%. So the savings under the swap of 0.9% would actually mean that BuddyX company would stand at W minus 0.3% after deducting the bank charge. Okay, so we are back. Sorry for the interruption. We had some minor interruption here, so that's why we had to actually pause the broadcast. But anyways, coming back to it, so you see that this BurryX company would actually have the net cost that BurryX company would bear is W minus 0.3%, and this counterparty is going to bear the net cost of not just 0.6%. 5.2%. So resultingly, if you actually go through it, what is actually going to happen? BurryX company actually borrowed from the bank at 4%, and borrowed from the bank, the counterparty borrowed from the bank at W plus 0.4%. And there is actually a bank fee of 0.5%. So if you summarize the whole of it, it is going to be W minus 4.9%. It's all going to be W plus 4.9%. If I actually would ask you people to reconcile this is going to be reconciled like this. The counterparty is bearing 5.2% and BurryX company is bearing 0. W minus 0.3. So it is all resulting in W plus 4.9%. So basically the question's requirement is that what is the net cost that is going to be borne by BurryX company. So we did discuss that BurryX company net interest cost is actually going to be W minus 0.3%. How? Because had there been no swap, the BurryX company would have been paying interest at W plus 0.6%. And if we deduct the saving net of the bank fee, so we end up at W minus 0.3%. So I've actually reconciled that how the whole cost goes on. Is it okay to you people? Okay, is it okay? Okay. Um, so before we move forward, we have got another requirement of this question, and that requirement of the question is going to cover up foreign currency risk also, and that requirement is also going to cover up the incorporation of the currency swap. So I'm actually going to have a short break for prayers. We'll have a namaz break and we will actually join back again. So it's actually going to be a namaz break till 7:20 p.m. So welcome back. So we were actually on to this question, and in this question, what we have done up till now is we have actually discussed that we have calculated, we have discussed the advantages and drawbacks of using the currency swap. In addition to this, we have also calculated the annual percentage savings which BuddyX company would make from using a currency swap compared with borrowing directly in Vertonia. Now, next situation is evaluate using the net present value. Evaluate using the net present value the financial acceptability of BuddyX company operating the rail franchise under the terms suggested by the government of Vertonia and calculate the gain or loss in euros from using the swap arrangement. Now, what is actually happening is the company is operating in a foreign country and the cash flows that are available to the company is actually in the foreign currency. So what exactly do we need to do in this case? We've got cash flows in year 0, cash flows in year 1, 2 and year 3. So that means what you need to do is that you've got cash flows which are actually expressed in terms of euros, euros, euros and euros. No, sorry. The cash flows which are actually expressed in terms of dollar, dollar, dollar and dollar, and you are actually based in Europe. So you need to convert all these cash flows into euro in order to calculate the NPV. So now how exactly are we actually going to do this? So first of all, what you need to do is that you need to calculate the forward exchange rates. You need to calculate the exchange rates. And what exactly are the exchange rates? You need to estimate the exchange rate that is going to be applicable in year 1, the exchange rate that's going to be applicable in year 2, and the exchange rate that's going to be applicable in year 3. So now if we actually talk about this, the exchange rate that will be applicable in year 1, year 2 and year 3. Now let's actually discuss. So what you need to do is that you need to estimate the exchange rate using the interest rate parity. Now if we talk about it, that how exactly are we going to calculate using the interest rate parity? So basically what happens is, in this specific scenario, you have got a spot rate. A spot rate of euro 0.143 is equivalent to $1, and you've got the inflations available in the various time periods. So what is actually going to happen is 0.143 multiplied by 1.06 divided by 1.03. Then whatever the answer is going to be, you need to multiply this answer with 1.04 divided by 1.08, and then whatever the answer is, it's going to be multiplied with 1.03 divided by 1.11. So can you please calculate? Okay, can you please perform the calculations for this? 0.1472 and 0.1417. Okay, so you have got the exchange rate for the various dates. Now what you need to do is that you need to perform the calculations for the NPV. Now how exactly are you going to perform the calculation? It's going to be year 0, year 1, year 2 and year 3. No, in fact what we could do is that since it's a simple calculation, so we could do it vertically also. Cash flow in terms of dollars, then the exchange rate, and then the cash flow in terms of euro. Then there is this actually discount factor, and then you will have the present value. So now what exactly is going to happen? We have got an investment in year 0, and that investment is actually of 5,000. For year 1, year 2 and year 3, we have got 600, 600, and in the year 3 we are actually going to get 601, and we are also going to get in total 7,500. So we have got actually uh, 5,000 as a receipt 1, and other is actually 3,100. Now what is this 3,100? How do we get 3,100? So we are going to get 7,500, of which 5,000 is the original principal, the remaining is 2,500. You add 600 to it, it would become 3,100. Now, so what is actually going to happen is the question actually told you that the swap is such that you can actually exchange the principal immediately, and and in 3 years time, both these swaps being at today's spot rate. So what is going to happen is you will have the rate of 0.143 here, have the rate of 0.143 here, you'll have the rate of 0.143 here, and the rate of 0.1472, 0.1417 and 0.1315. So if we convert this into euros, convert them into euro, discount them using the 14% rate, how much do we have the as an NPV? Okay, for the 3100, I did give an explanation that the 3100 came in this way, that it was actually 7,500 that was to be received in the last year, out of which the 5,000 principal is actually going to be converted using the original spot rate, because that's what it has been agreed. But the remaining amount, the 2,500. Okay, so perfect. So how much is the NPV that we are getting? Somebody is saying it's 146.83 positive. Is that how it is? 185.64, 1556.29. Anyone else? Okay, even the examiner's answer is actually euro 185 million. Okay, so if you're not getting it, then we need to actually perform the calculation. So please give some calculations. How much is it actually going to be? 5,000 converted at 0.143. How much is it? It's 715. And then what next? And what next? It can't be 88. Okay, it's 88.32. And then 85. And then 275.15. And then 482.6. So you have a discount rate of 14%. So you need to now discount it and calculate the NPV. So I think somebody has also calculated the discounted values. Okay, 407.65. Okay, 715. Okay, just calculate the PV, the present value. Okay. Okay, so it comes out to be 185.25. Okay, I think it's all rounding off thing, but it's approximately 185, 186, 170, 175. It all depends upon how you round it up. So basically the question's requirement was that we were supposed to calculate the NPV using the financial and need to determine the financial acceptability of the project. So we have done that. Last requirement is calculate the results of the hedging the receipt of 7,500 million using the currency options and discuss whether currency options would be a better method of hedging this receipt rather than a currency swap. Now let's just actually talk about it. If we talk about if the receipt of 7,500, if receipt under swap, if receipt is under swap, then what is actually happening? 5,000 pound is being received as 0.143 and the remaining 2,500 pound are being received at the exchange rate of 0.1315. So how much does it turn out to be? 328.75. Resultingly, how much is it all turning out to be? 1043.75. Now, the examiner's requirement is that if this 7,500 is not hedged using the swap and instead we use the interest rate options, then what is actually going to happen? So if you are going to use the interest rate option, then the first thing is you need to actually, first of all, you need to compare that how much will you get under the swap. First of all, you need to consider how much you will get under the swap. Now, if you actually operate under the swap, if the receipt is under the swap, then it is actually going to be 1043.75. It's going to be 1043.75. Now, what next? So the receipt under the swap is going to be 1043.75. What next? If under the options, if under options, then what is going to happen? If the receipt are going to be under the option, then what options do we have? The exercise price Quotation is in Vertonia, so and so. Premium is percentage amount translated at today's spot rate. So the exercise price is 7.75. Then you have got a call option and the put option. Exercise price 7.25, call option and put option. Now, what exactly are we going to do actually? Assume that we are going to try and we are going to work out on both the exchange prices. Now, if the exercise price is 7.75, the spot rate of 0.1315, if expressed inversely, so what you need to do is that you need to say it's 1 upon 0.1315. 7.6045. So now what do we actually want to do? We actually want to have, these are the options on, these are actually the options. These are actually the options in Vertonia dollar. That is, they are the options on Vertonia dollar. So we are actually going to receive Vertonia dollar. We need to sell these Vertonia dollar. So if we need to sell these Vertonia dollar, we need to go for the put options. So we can either have a put option at 7.75 or we can have a put option at 7.25. Now, first of all, let's talk. In case if you have got 7,500 and the spot rate is 7.6045 and you actually have a option that you can actually sell at 7.75, what will you do? Now, first of all, this is actually an indirect quote. So what actually needs to be done is that the amount of 7,500 is going to be divided by the exchange rate, and we would want that since we want to maximize the receipt, so we want to divide by the lowest possible rate. So exercise, the answer is going to be no. So what is going to be the applicable rate? The applicable rate is going to be 7.6045, and the amount is going to be, you will have 7,500 divided by 7.6045. The amount is going to be what? It's going to be 986.25, and then you will also have to pay the option premium. So it would also be minus, so it would not be worthwhile going for this. Similarly, if we would have actually taken the exercise price as 7.25, so this 7.6045, you would, yes, exercise the option. The applicable rate is going to be 7.25. If you use the 7.25 as a rate, then what is actually going to happen? 7,500 divided by 7.25. So it is actually going to be 1,034. It's going to be 1,034. If it's actually going to be 1,034, what we need to do is that we need to deduct the option premium out of it also. The option premium, how much is that premium going to be? The premium is actually 1.6%. So how would you calculate the premium as 1.6%? It's 1.6% of the amount hedged. So 7,500 into 1.6% is going to be 120. It's going to be $120. If you convert this using the exchange rate, what is that exchange rate? The exchange rate, since the option is premium upfront, the exchange rate is going to be 0.143. In fact, no. For this, we have an option premium of something else. It's 2.7%. 0.143. Okay, so this is how you are actually gonna solve it. Okay, do you people get it? Okay, so the question's requirement was that should we go for the swap or should we go for the options? So under the swap we have got 1043, under the options we would have 1005. So it's better that you go for the swap rather than going for the option. It's better that you go for the swap rather than going for the options, because the option would lead to a lower receipt. Okay, in the narrative form you would say that in case if you decide to hedge the receipt of 7,500, in case if you decide to hedge the receipt of 7,500 euro using the swap, then you will end up getting euro 1043. But similarly, if dollar 7,500 is hedged using options, you'll get a receipt of 1,005 euro. Okay. So I think that's the conclusion of this question, where the question actually requested us that amongst the various things, the question actually covered up the swap, the question covered up the foreign currency investment, and has also covered up the opportunity to hedge using the options instead of using the swap. So I hope it's actually clear to all of you. Okay, Zohaib Ali is asking why did we use the put option? So the reason for using the put option was basically, you see, the options were actually in terms of dollar. They were the options on dollar. They were the options on dollar. What does it actually mean? They were the options on dollar. It actually means they were the option to buy or option to sell the dollars. So since we are actually a European company, the dollars that we are actually going to receive, we don't need those dollars. We don't need to keep those dollars. We need to sell them. So we are actually going to sell them. So that's why we need an option to sell the dollars. Okay. Anyone has any other question? Okay, so I think that's it for today. We're gonna keep it till here. And what I'm actually gonna do is that I'm going to cover up the restructuring in the tomorrow's session, and hopefully that we would be able to do one long question of 50 marks of the restructuring. That's what I would try to do for the tomorrow's session. So if any one of you has any feedback, we would be highly appreciating the feedback if we could get it from you people, because from tomorrow we are not going to be continuing the risk management anymore. I think we have had enough of the risk management. So we are now going to move on to restructuring, and then I would try to have a question of the mergers and acquisitions also, because merger acquisition and the restructuring is a hybrid topic that's regularly examined. Okay, we'll appreciate if you people could share your feedback. Peter and Jangwa, you would inshallah pass. It's not just about getting the good grade, you would hopefully pass also. Because Peter Jangwa is saying that I'm gaining confidence that I can attain a good grade if not a pass. No, hopefully you're gonna get a pass. It's not just going to be the good grade. Amin Lakhani, yes, the presentation is going to be available. The recorded lectures are available on Vimeo also. Mohammad Azim, for the narrative form, I think the best approach to go for is the past paper exam questions. That's the best approach that you can use. You use the past paper question, you read out the theory that's written in the question, and you can learn the best out of it, because you don't have time to actually go through the entire book right now. Um, Okay, so thank you very much, everybody. Thank you for your time and thank you for your feedbacks. It's all highly appreciated. We would hopefully have a restructuring tomorrow. Yes, we can do it at the end of the webinar. We can do it at the end of the webinar. Smile, the lectures are uploaded every day in the evening. So you could probably access them late in the evening, or you could access them in the early morning tomorrow. Okay. So thank you for your time. Thank you very much.